morning, everybody. Thank you for joining us on this sunny but windy evening here on Wednesday. And we wanted to put on another webinar because of what's going on in the news at the moment. For those of you that don't know me, I'm David Braithwaite. I'm the Managing Director of Citrus Financial Management Limited. Today's webinar is going to be 45 minutes, and I'm really quite prudent with my timekeeping, so I'm also want to be respectful of your time as well while we're here. But at the end of this webinar, what I'm hoping to do is to take your questions and answers. So at the moment, we have got several participants that are all joining us right now. So I'll keep chatting for a bit longer because we've got a lot of people that we're due to be talking to today. But there's no such thing as a silly question. We're going to be trying to cover as much as we possibly can while we're actually here. And we want to make sure that we can answer as many questions as we can towards the end. But if it's appropriate, we'll take them during the panelists' discussion at the same time. So what there is at the bottom of your Zoom screen is a Q&A. The little chat box, two little speech bubbles. You just need to tap on there and then type your question into there. And I will be monitoring the Q&A as it comes in and as the actual webinar progresses. So we'll also, anybody that's on this webinar today, if you do miss anything, we're also going to promise to send you a recording of the webinar so you can look back at it and revert to it later on as well. And we're also going to make the recording available to anybody else should they want to see it. But this is live, so literally anything can happen, but that's half the fun, isn't it? So onto our topic, the economic storm and the mortgage time bomb, which sounds really quite dramatic, doesn't it? But let's be honest, at the moment, economically, I think a lot of us are wondering where things are at with the economy, what's happening to our money, the pound in our pocket, mortgages, our investments, pensions, everything that's going on at the moment. It just seems to be a never-ending storm of bad news that's coming out with regards to the economy. We've got the cost of living crisis, we've got high inflation, we've got interest rates going up as well. And it all places a strain on everybody. We're all consumers here. We're all earning money. We're all trying to save money. We're all trying to make as much money as we can at the same time. And at the end of the day, who knows when it's actually all going to end? On top of that, we are still feeling the effects, bizarrely or not, of the spring budget and the autumn statement. While the changes that we saw in various tax breaks to do with pensions and savings and income tax, it hasn't really filtered through, I don't think, until now, which is when we're starting to see the effects of some of this actually take shape. So we're going to be spending a bit more time delving into those changes to reappraise you with what's going on with those at the moment. Plus, if that wasn't enough, mortgage rates in the headlines all the time. It feels like it's back in 1980 and 1990 all over again. With the daily basis, it seems, of interest rates changing with our mortgage companies. And where does that leave us? So we're going to be talking about mortgages. So with the help of my very special guests, we're going to take you through as much of that detail as we possibly can. Take your Q&As. As I said, you do put the questions into our chat box and we will get round to answering as many as we possibly can. And if we can't, we will get back to you after with your answer. That's a promise. Okay. So how can you actually protect your own financial future? So I'm very lucky to be joined today by 4 panelists, I think, which is the most we've ever had from our panel because we have got so much to discuss at the moment. So let's start with Leslie. Leslie Stewart is the Advice Solutions Manager for Quilter Financial Planning. This is her 3rd appearance on one of our Citrus webinars. More than 25 years experience, been 3 years with Quilter and performed various advice and proposition roles within various financial advice companies, networks, and also the nationwide that we all know and love. We also have Holly. Holly Bettles is our very own in-house mortgage and protection advisor here with Citrus Financial, and has been a mortgage advisor for more than 10 years and probably has never been busier than what she has been for the last year, I wouldn't have thought, because of everything that's been going on, trying to manage that. Holly started off giving advice originally within an estate agency background before moving to Lloyds Bank, and she joined us a couple of years ago and has become a really valuable member of the team, helping as many people as we can with all their mortgages. Apparently, she's also a demon cake maker and party organizer as well, so you know where to come. We also have Craig. Craig Brady is our senior financial planner here at Citrus and is probably a well-known familiar face to many of you. Has got a great area of expertise, very technically suited in terms of giving advice, and is just a great all-round guy to actually talk to when you're looking for financial planning advice. Joined us in 2016, got a wealth of financial planning experience, tax planning, investment planning, pension planning, inheritance tax planning, anything you need to know. Craig is your guru to go for. A little known fact about him, apparently he's one of the last remaining Maidstone United supporters. Who knew? So there we go. And lastly, Richard Harris is here. Richard has been with us for a few years now, and Richard is my COO. So he sort of does a lot of the overlooking of how the business is doing and does a lot of the figures and the number crunching for me behind the scenes. But also, because of his background in banking and retail and commercial banking and the leadership roles he's had there with various big banks that are national, his knowledge of economics and the investment scenario and the economy in general is second to none. So we are going to start off by, first of all, talking to Richard about the economy in general. So Richard, you know the economy probably better than anybody at the moment. So what actually is going on there? What's the current state of the economy, and what can we expect to see in the current months that are coming up? I know it's hard to predict. What do you see the future looking like at the moment?
Thanks, David. Yeah, there's probably never been more media activity around some of the economic numbers than there has been over the last couple of months. So I thought today, very briefly, I would start with base rates, because actually that is something that is being talked about an awful lot right now. So if we take a quick look at where base rates stand, we know Bank of England most recently announced the increase 0.5% up to 5%. The reason I like kind of showing on a graph like this is just it makes you remember quite how long we had low bank base rate for. So actually the last time the bank base rate was 5% was in April 2008. But it is definitely one of those things we're experiencing now. And I appreciate there may be some people watching us today who do remember back to November 79, when in fact the bank base rate was 17%, probably looking at that 5% going, what's all the noise about? But actually, it's been so long that we had particularly low rates, obviously, and it bottomed out in March 2020 at 0.1%. And I think that's one of the big factors we are experiencing now, which for a big chunk of the population, they just haven't experienced rates kind of rising to this level and quite so quickly to this level as well. So that's where we stand at the moment, 5%. And I guess remembering why is this happening? So what the Bank of England are trying to do is if you imagine the UK economy as our car going along very nicely, well, the Bank of England are trying to hit the brake pedal because in spite of what the IMF said going back to earlier in the year, the IMF predicted that, frankly, out of all the G7 countries, Britain would be the worst performing in 2023. It would have a negative economy in 2023. Actually, that's about the last time you heard much from them, because obviously since then, the performance of the economy has been upgraded and upgraded again. And it's probably one of those things where good news doesn't really hit the media that much. But there is good news in that UK PLC overall was doing better than expected. And I guess that translates through to the next topic, which is something that's being talked about equally as much, which is inflation. So I talk about this for anybody that's watching my monthly Citrus Bites videos that are coming out. I've talked about this now probably all the way back to the start of the year. So there's two numbers that you hear talked about. There's the grey line, which is consumer price index inflation, and there's the green line, which is known as core consumer price index inflation. And I guess it's always, well, what's the difference between them? Well, fundamentally, the grey line includes really volatile things such as energy and food. So energy prices we know can go up really quickly, come down really quickly. Likewise, food is proving to be very volatile, and that can really distort the number. So the number perhaps we want to be looking at is the green line. It's the core inflation. And the best way I always talk about that is it's sticky. And the reason the green line matters is because sticky inflation is much harder to try and get out of the economy. So now we're starting to hear core inflation be the one that is talked about a bit more. But on a 12-month rolling basis, we're now up 7.1%. So when you look at that, actually, the other really important point is where some of the news last month when the inflation figures came out was it's flat April to May. That was CPI. Core inflation, which is the sticky one, went up month on month. And that is a concern because it's now at the highest point since March 1992. So we know that core inflation, sticky inflation, is proving really, really challenging. And that's certainly a big reason why we're seeing that brake pedal called interest rates continually being pushed to try and slow this down. I'm going to talk a little bit about, just for a moment, why might that be? Why are we experiencing now, in spite of all these bank base rate increases, in spite of all the noise that we're hearing around, the impact that's having on consumers and mortgage payment capabilities, why are we still seeing this inflation number go up, this core inflation number? So I just picked out a couple of bits that I thought might be interesting to look at. The first one is how our mortgage market has changed over the last few years. And I don't want you to worry too much about the indices that you'll see. What I do want you to look at is the colors here. So the colors tell the story. And what we've noticed over the last few years is many more borrowers have gone on to longer term fixed rate products. So I think the view generally is, since the start of the bank base rate increase through to the end of 2024, we're predicted about just over 4 million households are going to come to the end of a fixed rate mortgage product. But what's particularly interesting here is the percentage that are on longer term rates, so the 3, 4, 5 year products. And the reason this matters is because, in spite of the fact the Bank of England may be pressing that interest rate pedal, trying to slow the economy, actually there's a certain percentage of households that are not impacted. And worth overlaying with that, and this is something, I didn't realize till I started getting under the skin of it more, but we tend to think mortgage, so many people have got a mortgage, and that potentially is true. But when you look at UK households as an overall, 29% of the UK population are in a household where there is a mortgage on it. So 29%. So actually less than a third of UK households actually have a mortgage outstanding. And now we overlay that with the fact that so many of them are being taken over a longer period of time. Hence, we're seeing that distortion between how long it's taking for consumer behavior in many instances to change in spite of those bank base rate increases. And I'm sure Holly will talk a bit more about kind of mortgage rates and the impact of mortgage rates later on. So that's a little bit about one reason why we might be seeing such a delay in consumers changing their spending capabilities. But the other point I wanted to look at was just about jobs, because the other question I get asked is, Richard, how come we got this so wrong? Couldn't we tell that it was going to be harder to try and crack this inflation? Why are we suddenly seeing such a huge acceleration in bank base rate, which was tend to indicate, is there a bit of panic in there? And I look back at, 2020, 2021, and this is really interesting with the jobs market. And jobs is getting much more noise now around, well, what is fueling some of this inflation? So the grey line is all of the vacancies that exist within the UK, and the green line is unemployment. And what you can see that started happening over 2020, 2021 is the number of vacancies in the economy went up. That meant there just weren't enough people to fill the jobs. And what's happening when there aren't enough people to fill the jobs? Well, typically employers go, we need to hire people. So actually, we're going to need to offer people more money. We want to retain our great people. We want to attract new talent. So we're going to need to pay them more money to do that. How are we going to pay for that? Well, we'll have to put our prices up. So in the end, what you start to see is you start to see employers increasing salaries, wages lead to inflation, and that's driving it. So perhaps actually there was a really early indication available that this is what might be coming down the line. And it probably explains a bit more about why the government are also really, really trying to stick to the public wage increases and saying we are determined not to give big public wage increases to try and put a lid on that inflation. So I guess in reality, we don't hear about some of the good stuff. We don't hear that perhaps new car sales went up for the 10th consecutive month in June. What we do hear about is as there are many people struggling now with the bank base rate increases, but there's a lot of sort of strong economic data underpinning that news as well.
Brilliant. Thank you, Richard. Really interesting seeing, especially with the people with the longer term fixed rates that haven't seen the effect of this yet. So it's going to be an interesting way that it plays out. I want to come to Leslie now. Now, I mentioned in the introduction about the spring budget that we had, the autumn statement that we had, and we haven't really seen necessarily the full effects of that yet. I mean, I don't want to mention the word stealth tax, but is that valid? Are we expecting a surprise around the corner?
Yes, that's very valid. So yeah, I just wanted to talk a little bit about the autumn statement and about the spring statement and what it really means for you basically. So if we think about the autumn statement first, came hot on the heels of the disastrous mini budget. I think the less we say about that, the better. So let's start with income tax. So we didn't expect big we didn't expect kind of big giveaways in this budget, but most allowances have been frozen. So if we look at income tax, for example, the personal allowance is frozen at 12,570. The higher rate tax threshold is frozen at 37,700. And the point at which you start paying additional rate tax has been reduced from 150 to 125,140, and that aligns with the personal allowance, which you lose for is reduced by £1 for every £2 of earnings over 100,000. Now that last one has been frozen, and actually that last one was introduced back in 2010 by Alistair Darling, which is quite surprising. That's back in 2010, and they've now all been frozen until 2028, which if you take that last one for example, it means we've had that for 18 years. Well, or we'll have it for 18 years, and in a period of high inflation and high wage rises, you can really see how fiscal drag is happening. So let me give you some examples of how a sales tax is really impacting everybody. So for an average person on 35,000, even if we just assume 5% growth, they will actually be paying an additional £695 by 2028. And overall, over that whole 5-year period, they'd actually be paying just over £2,000. And for someone on £50,000, by 28, they'd be paying an additional £3,400. And over the 5-year period, that actually equates to £9,765, which is the price of a small car, although probably not in 2028. It'll probably be a lot more than that. So you can see how it's dragging more people into paying more tax, even though taxes haven't actually gone up. And I'm sure Craig will later on touch on some of the ways that you can mitigate that. So I also just wanted to talk a little bit about IHT. Again, this was frozen at 325,000, and that again has been frozen now since 2010. So again, we've had this, not only have we had high inflation, but we've had house prices have almost doubled in that time, albeit they are kind of starting to ease off a bit now. Now, we did have the introduction of the residential nil rate band in 2006, and that meant for married couples, your IHT allowance is up to £1 million. But so for a while we did see IHT receipts falling, but they're now very much on the rise again, and again more families, more estates are being dragged into IHT. So for the 2021-22 tax year, it was actually 6.1 billion that the government collected, and that was an increase on the previous tax year of 14%. Now, from April 22 to January 23, they've already collected 5.9 billion. So that's an increase of 15%. So you can see the direction that all of these taxes are going in. So lastly, I just want to talk about CGT. So the autumn statement, most allowances were frozen, but CGT, some of those allowances were actually reduced. So previously it went from just over 12,000. In this tax year, your CGT allowance is 6,000, and in the next tax year, it's 3,000. Likewise, the dividend allowance was halved from 2,000 to 1,000, and in the next tax year, it will be £500. So again, it's it was an easy tax to target because it only actually impacts about 325,000 people pay CGT. But again, you can see how more of you will be dragged into paying CGT. It only takes holding a few kind of single company shares, or some of you may have a kind of second property or a rental property that may now be dragged into CGT, where previously it may have been under the allowance. But it's not all doom and gloom. I mean, Richard talked about the employment situation, and certainly that is a problem. And when we come to the spring statement on the 15th of March, there was actually a bit of a ray of light, a bit of good news. So, and this was all around pensions. So the big headline was that the lifetime allowance was scrapped. So this will be removed, which means that that's the amount that you can save into a pension during your lifetime. So that's now been removed, although the tax-free cash element has been frozen at 268,275. But one of the things that you may have missed, which didn't kind of grab quite so many headlines, is that also the annual allowance has been increased, and that was increased from 40,000 to 60,000. Now, this is really good news, because going back to those income tax figures that I was talking about, it does mean, I mean, not a lot, but it does mean that you do now have more scope for planning. And that, you know, so end on a bit of a high note there, David.
Yes, thank you very much. And it's interesting when you talk about things like CGT, which is capital gains tax, how it used to be a tax that only the people that were quite wealthy seem to pay. And now actually more and more of us are going to fall into that sort of category that's there. And we have got some questions coming in actually, which are interesting, which I'm going to come to as soon as I can at the end. So just a reminder, anybody who's got any questions at all, do put them to the Q&A and I will get round to as many of them as I possibly can. And we'll see how many we can get answered at the end. So Craig, a bit of an introduction there for you. So when we actually listen to what Leslie's saying about the changes that there are now for the tax, we need to be more tax efficient with what we're doing. What are the various ways in which we can actually be more tax efficient in what it is that we do with our finances?
Sure. I mean, we could spend all day speaking about the different investment vehicles. It's probably why my wife loves me so much. So I'll try and keep it short and sweet today for the purpose of the webinar. So the first thing I would advise clients, really simple, make sure any savings investments you do are in the correct name for tax purposes. Now, it seems a very straightforward thing to do. Yeah, interest rates now for 1 year fixed, touching around 6%. Doesn't take much now in cash for an individual who's a high rate taxpayer, base rate taxpayer, to go over their savings allowance. So just to recap, the savings allowance is £1,000 for a basic rate taxpayer, 500 for a higher. So it's, you know, and you can start with savings, you can go onto your investments, you can go into your pensions. Especially if you're a married couple, make sure you think about, okay, well, whose name should we put things in? That is really, really important.
And we're thinking about inflation as well, Craig. It was a great point about the right name. We're thinking now about sort of inflation. How is that having an impact generally on people's finances? I mean, it sounds like maybe a silly question, but what do you see out there with your clients that you're talking to and the effect that it has on you as well?
Yeah, so yeah, everyone's in the same boat, aren't they? Everyone's bills are going up. Everyone goes to the shops and spends £100 and gets home with nothing. You know, we're all feeling the same. Especially people with mortgages coming up, you know, they're, you know, like myself, mine's up in April. So that's going to be a pleasant surprise, I'm sure, when that comes up for renewal. So we're kind of all in the same boat. So what I've been telling clients, you know, you have to get clever in terms of your tax planning. You know, investment funds, you know, they've been pretty flat, if we're honest. Some high risk funds have done quite well in the last year, but everything else fairly flat. So it's making sure A, you don't panic, and B, you know, you get clever in terms of your tax planning. So take pensions, for example. Everyone can pay into a pension as long as they're under 75, even if you have no earnings. If you have no earnings, you can pay £2,880 in for the tax year, and you get an uplift of £720. So you're making 25% just on paying into a pension. Likewise,
and there's no lower limit on the age either, is there?
No lower limit on the age. So you can start from day one. Yeah, obviously a baby's not going to be able to open a pension, but someone can do it on their behalf. And it's just sensible, you know, you're getting that 25% uplift on that net amount. For people that are, you know, earning above 50,000 who have children, they'll be subject to child benefit charge, where you have to give a portion of your child benefit you claim back if you earn between 50 and 60,000. Now, if you pay into your pension, this is why I'm saying be careful about whose names you're doing it in. There's a couple. If you pay into a pension and get your what's called adjusted net income down to 50,000, you get back all of your child benefit, which is exactly the same if you earn over 100,000. Once you earn over 100,000, as Leslie said, you start to lose your personal allowance. Now, if the individual pays enough into their pension to bring their adjusted net income down to 100,000, they get 60% tax relief. you know, you are not going to get that return anywhere else.
But it's often the case with pensions and the things, it's knowing these things, isn't it? And it's often with our pensions, we all know that they're very important, but not a lot of people pay that much attention to them until we all get a bit older. And it's about having that focus and talking about starting pensions for children and stuff. That sounds like quite a strange thing to do, but the sooner you can do that, this planning, the better you're going to be, aren't you?
Yeah, I think you know, we're still quite stuck as kind of a generation on names. So pension, everyone just assumes, you know, you have to be of an age to start saving for a pension, and you will use it to fund your retirement. When really all a pension is a tax wrapper. You know, for a normal, you know, client, if you have ISAs and if you have pensions, you should start drawing on your ISAs first. The pension should now be the last thing you touch. So it's just like any other investment. It's just the name that people still look at and think, oh, well, you know, that's for my retirement. It's not necessarily so.
And talk about the death benefits that are around with a pension as well, as to why you wouldn't necessarily touch your pension compared to actually maybe using your savings, which sounds on the face of it counterproductive, but there's a reason, isn't there?
Yeah, there is. So a personal pension on death is free of any inheritance tax, as long as there's a valid expression of wish form completed, a nomination on that pension. Now with the lifetime allowance being scrapped, you know, that means whatever is in your pension can pass your beneficiaries free of inheritance tax. Whereas with ISAs, they are included inside your estate and possibly subject to 40%. So effectively, most of your other savings investments will be subject to inheritance tax. Your pension will not be.
Really good point. Thank you. Now, I'm going to ask you a question, which I think a lot of us are coming up against at the moment. And we mentioned that you can get a higher interest rate now in cash. So the average rate I looked at the other day is 2.53. So there are some outliers out. There's one that was, you've mentioned, at 6%, just over for a 1 year. Now, why would people continue with investing as opposed to just putting the money in cash? Because you're now getting a real rate of return on cash. So why would people keep investing?
Yeah, I mean, it really depends on the client and their objectives. You know, when you meet a client on day one, you'll set out a range of objectives, such as, you know, possibly school fees planning, retirement planning, life goals, so on and so forth. So it really all depends at what stage of the journey you're on as a client. If you're coming up to a certain event, then obviously being able to secure a relatively high interest rate, if you're looking at recent history at zero risk, could seem appealing. But I actually think we've got a graph to show the difference. You know, when you're talking, I mean, we're, you know, as humans, we're very short-termism in terms of our conversations, our chat. You know, all we're thinking about at the moment, individuals in the news, is high inflation, high interest rates. We're not thinking about the long term. And, you know, you can see this graph here. So it goes back to 1992. And just what a difference the return on cash compared to all other asset classes. And all of the one-off events that have happened, and they just, you know, appear as blips in terms of a journey. None of those you could really predict or see coming, and they all have a small effect at the time. You know, we'll remember, you know, COVID and that sharp downturn at the time. It seemed like the world was going to end. And here we are, you know, 3 years later, back to how he was. And, you know, look what happens to investment since then. So this graph really just illustrates the importance of, we can all talk and, you know, think about, okay, what might happen tomorrow. But the reality is none of us know. Things change so quickly. So it just puts into context the benefits of remaining invested for the long term.
Excellent. Thank you very much, Craig. We've got some questions coming in for you, definitely with your name on here. But I need to go across now to Holly. Before we run out of time, obviously we wanted to get Holly's take on this, because you just mentioned about mortgages, and Richard touched on the difference in the fact that we've got a lot of 5-year fixed rates that haven't come to the end yet, that were on really good rates. So with the Bank of England now, base rate 5%, we saw yesterday that there are various sort of two. Give us a summary, Holly. So what are we looking at in terms of mortgage rates now for a shorter term rate compared to, say, a longer term rate, compared to what we were looking at even, say, a year ago?
Oh, well, do you want the good news? My plea here is the same as Craig's, actually. It's don't panic and think ahead. I think that is just a really important thing to kind of put out there before we go into what this looks like now compared to then. And as Richard said, actually, we've all been so used to really low rates that this is going to be a shock for a lot of people. And therefore, we just need to manage those expectations and just let people know what options are out there. But for rates, yeah, they've doubled pretty much since this time last year is the long short, if not more in some instances. The whole mortgage market's on its head a little bit, to be honest. In, you know, the nearly 15 years I've been doing mortgages, you're right, I don't think I've ever worked as hard. I think I deserve a pay rise, David, just FYI, just for that last year. But yeah, no, I think it's one of those things that it's all going to be really down to your personal circumstances. And that's the really important thing to remember here. You can watch a webinar and I can give you an overview of what's happening. The really important thing here is to talk to someone who is able to look at your specific set of circumstances, because one piece of advice right now could be really detrimental compared to another piece of advice that might be better for you. But yeah, it's not very often you see a 5-year fixed rate being cheaper than a 2-year fixed rate, which is kind of where we're sat at the moment.
Could you give us some context on those rates, Holly, at all? Just give so what is an average 5-year fixed rate now, or what's an average 2-year fixed, and what were we looking at previously? So I know lots of people had 5-year fixed with a 1 at the front of them, didn't they? What sort of rates are we looking at now, and what rates were we at before?
Yeah, so I mean, the best rate we kind of saw 12-18 months ago was like 1.19 for, you know, a 2-year fixed rate, which was cracking, like brilliant, but it kind of wasn't the norm. Now for a kind of a 2-year fixed rate, I think the average they're quoting is about 6.6%. There are some that are a bit cheaper, there are some that are more expensive. It's going to depend who you're eligible to go with, and that's quite a big part of this as well. Actually, you have the option to stick with who you're with, or we have the option to try and move you somewhere else. Now, we've got to get through affordability if we're going to move it somewhere else. We need time to look at that. We need time to action that. And the quicker you action these things, whatever you're doing right now, the better, because we can tie stuff in early. We don't have to wait for crunch time. If you stick your head in the sand, this is going to be more expensive for you. Action now, talk to someone now, and then actually kind of, you know, get that ball rolling, because if we need to check affordability, we need to make sure that's an option. If not, we need to tie in something with your existing lender where they're not going to be doing an affordability check. And we've got to look at all of those things, and we've got to decide based on your plans and your circumstances what the best route is going to be for you going forward.
Excellent, thank you. And there's a question that's come just for you here, which I'm going to come to in a moment. But generally about the housing market, are things moving? I know we're seeing a lot in the media. It's a lot of doom and gloom, and it depends on what paper you read, indeed, as to what survey they took at the time. But are you still noticing people are still moving? There's an appetite to still move and climb the ladder, as it were?
Yeah, absolutely. Like, you know, you would almost think, reading the papers and watching the news, that no one's doing anything other than panicking. And actually, that's not the case. You know, first-time buyers are still contacting us. We are still doing mortgages. I moved my brother just last week. You know, I didn't want to have to do the moving element of it. I did as well as the mortgage, but I did because I'm a kind sister. But you know what? Actually, he's just upsized, and he kind of looked at it as his whole budget. And that's the thing with this. It's looking at it holistically. And I know everything is going up, but it's actually taking that viewpoint of, this is everything we're going to have to pay. This is what this looks like now, and getting that foresight and that, you know, that leg up on that almost is going to be really beneficial for you. So yeah, we've still got people contacting us wanting to move, first time buyers, because to them, this is going to be the norm. This is what they're budgeting for.
So if somebody is struggling with their mortgage, and there will likely be people out there that are, they're facing into the fact that their mortgage rate's gone up, they've just had gas and electric bills all going up, what should they do if they're going to be struggling with their mortgage payments? Is there any help for them?
Yeah, so first off is always, you know, speak to a broker and see if there's anything, just to actually get your facts of what your figures are going to look like. Second off is, when you get those figures, if you sit there and go, there's just no way that this adds up at the end of the month, please contact your lenders. They will be able to advise you and help you. They do have specific parts of their business that are set up for that. We've also had the mortgage charter, which has been very recently introduced, which we're getting a lot of emails through the broker email saying that the big lenders and the small ones are signing up to the mortgage charter, where they're going to give you options like being able to move on to interest only for a very set period of time, but to help out with your immediate budget. There's the option of being able to extend terms without potentially having to look at affordability checks. So it's going to be dependent on which lender, what they take on. They're going to be a little bit of a delay getting them to implement that into their systems, but it is definitely something that they are gearing up for, and they appreciate that not everybody is going to be able to find an extra £200, £400, £600, £800 a month. And therefore, if you are sitting there thinking, I just don't know how I'm going to do this, please talk to them, because they will want to help you. They aren't just going to want to immediately take your keys away from you. So yeah, that's my plight. Don't panic, act early. If you really are in trouble, talk to your lender. They will try and help you.
Excellent. Thank you. Great advice, Holly. So I'm going to come straight to you, Holly, we got several Q&As come in here, and I think it makes sense to follow on that conversation. I'll come to one of the last questions first for you, Holly. And I won't mention any names that are in here. Obviously, I want to keep anyone anonymous. But with a mortgage renewal due in October next year, should I be looking now if they are likely to still be going up, or should we hold our nerve and wait for Q1 or even Q2 next year?
Good question. So you have a couple of options here. As you say, you can hold your nerve, you can wait and see. Current predictions that things are going to continue to increase. Whether that's right or wrong, crystal ball gazing, we don't know. You can hold your nerve and see what happens. I guess that depends on your budget and how much extra you've got there. What I would potentially suggest you do is we can look at tying in a rate with a new lender, providing the affordability fits. That would give you a 6-month window. If your fixed rate doesn't finish within that 6 months, it may be worthwhile paying the early repayment charge to come out of it early, based on what rates would look like at that point. If they've gone up so high or so far at that point that you're better off paying your early repayment charge, if you've acted now, you will have something in your back pocket. That isn't going to be for everyone. Not everyone's going to want to do that, but it is an option that you can look at, because we can choose to use it or we can choose to ditch it.
Yeah. Excellent. Thank you very much. There's another question coming here. We're looking to move. Is this a bad time? Difficult, isn't it? We need the crystal ball, really, isn't it? That everybody should have.
I think it depends what you're looking to do. Anyone who's looking to, like flip properties at the moment and do them up and sell them on, no, I probably wouldn't recommend that as the best idea right now. But actually, if you're looking for your long-term home, house prices are still, we're not seeing down valuations at the moment, touch wood. That's not something that's happening right now. So if your house is still worth X and you can afford to borrow more and it's comfortable for you and you want to buy Y, then whatever happens in the next couple of years doesn't really matter. It comes out in the wash. It's your long-term plan. Just like Craig is saying, it's that long-term goal, that long-term overview of going, what works for me? And I wouldn't say to anyone, don't move right now, because if that's what's right for them and they can afford to do it, then great. I think it's just, again, talk to someone, get an overview, sit down, crunch your numbers, figure out what's right for you.
Excellent. Thank you, Holly. Right, I'm going to go to the rest of our panelists with some of this as well now, and I'm going to decide who's going to answer some of these questions, because actually most of you could actually answer these. So I'm going to start actually with a question for Richard. Actually, this is off the back of your economic update that you did kindly earlier on. And the question is, if there's a recession, will the bank be forced to lower interest rates?
Oh, interesting question. So I see it like this, to give you a very quick answer. In my car that's driving along, which is the UK economy, we've got the Bank of England pressing kind of the brake pedal, which is the interest rates. And then we've got others such as, private sector bosses pressing the accelerator pedal. Hence the wage increases, desperate to attract talent. And I think the goal is to try and make sure that the accelerator pedal is lifted gently, the brake pedal isn't pushed as hard, and that stops the cliff edge of a recession. So you're back to, are we talking hard landing, soft landing? How deep is the recession? I think ultimately what the government are saying in theirs, and this is something they've published this week, is inflation is the big thing they want to see come down within the 2% figure that they've quoted. So that's the thing they're most focused on. And what we do know is at the moment, if that means a recession, in order to keep interest rates going up to bring inflation down, they're prepared to see that happen. So, we need to watch out for that. I do think they won't be keen to create a deep recession, because actually that has its own consequences. But inflation coming down is the number one thing they're focusing on as a government right now.
Excellent. Thank you very much. Now I'm going to turn to Craig. When you say, because this is what you said about earlier on about being tax efficient, is having things in the right name. Do you mean the lower earner? What's your definition of right name?
It all depends what you're looking to do. So if you're talking purely, you have cash and you have cash accounts, and one of you is a higher rate taxpayer, one of you is a basic rate taxpayer, then obviously it'd be in the basic rate taxpayer's name to reduce your overall tax. Now, if you flip it to pension contributions, then obviously if one's a higher rate taxpayer and one's a lower rate taxpayer, you want the pension contribution to go to the higher rate taxpayer so you can claim the 40% tax relief. So yeah, it all depends what you're looking to do, whether you're looking to save, invest, pensions, so on and so forth.
Excellent, thank you. And I think that's the thing is take advice, isn't it? Is to talk to. I mean, I'm not just saying us, but we're here to help you navigate that area, to make sure that you have got the right name, right tax wrapper, and it's as flexible as you can be. So thank you, Craig. Leslie, a question for you. You mentioned inheritance tax, which is the tax that you pay on your property and on your assets when you die. And questions come is, what is the amount that you can receive before you pay inheritance tax?
Well, that's actually quite a complicated question. So in terms of it's not really how much you can receive, it's how much the donor, kind of how much allowance the donor has available. So everyone has a nil rate band of 325,000. There are also other kind of annual allowances where you can kind of make gifts up to £3,000 per tax year. But how much you personally would pay if you were kind of left some money would really depend on who's left you the money, how much of their nil rate band they used, what they had available. So it's a really complicated question, and it would be on a case by case basis. But yeah, it should again, it's one that really both parties should be taking advice.
Excellent, thank you very much. Right, going back to you now, Craig. If I sell my holiday home, is capital gains tax an issue?
So if it's your holiday home, then yes, it will be an issue. Obviously, it depends if you ever lived in the property yourself as your main residence. But if we just assume you didn't, then yeah, you only get capital. Don't pay capital gains in your main residence. Any other residence, you'll be liable to capital gains tax.
Okay, thank you. And I'm now going to go to, I've got these different questions in front of me, and it's quite interesting as to who I think might be the best person to answer it. So this could either be for Holly or Richard, actually. Someone's asked, for a first-time buyer, do you think the property prices might fall, so therefore it's worth waiting? That's interesting. So I don't know whether Richard or Holly you want to take that. I'll let the first person take themselves off mute do it. And if not, I'm going to nominate one of you. Holly, there you go. Look, there you go.
No one will come off mute. No one wants to answer the question. It's a really difficult thing, and you know what, I don't think anybody really knows the answer. I think again it comes down to whatever position you're in right now. If you feel comfortable and confident doing it, then go ahead and do it, because if it's not going to be a really short-term thing, it'll all come out in the wash anyway. You'd be amazed at how quickly 5 years will fly by in your first home. So you know, it's one of those things that I wouldn't necessarily put it off, because you might find yourself in a more difficult situation. Lenders might change their affordability checks, interest rates might go so high that you couldn't afford to, but you could have done if you tied in for a five-year fixed rate, 12 months or 6 months ago. So I think it's always worthwhile asking the questions, finding out the facts, not what you find on Google or what your mate down the pub says, and then actually applying those facts to your specific scenario and seeing what you think you're most comfortable with.
Excellent. Thank you, Holly. I'm still going to come to you, Richard, because I want to get your comments as well on that, because you did put yourself off mute as well. So we're going to bring you in.
So it links a bit to your last question, David, that you said over, well, do we think interest rates will fall if there's a recession? And I think my general, for what I can say to that is, think about the current level of interest rates. Don't think about how cheap it's been to borrow money for the previous 15 years. Because actually, when you look at the average Bank of England base rate, going all the way back to the 70s or however long you want to go back, you will see that that last 15-year period is not a reflection of the norm. So don't plan for that in your calculations would be my best kind of guidance that I could give.
Thank you. Another question for you, Richard, about your economic update. Is the labour shortage due to the over 50s not working?
Good question. Not working is a harsh one. A number of people left the professional workplace during and after COVID. It just so happens a lot of them were over 50, which makes a change, David, because I thought you were going to come up with a B word and go, is it because of Brexit, which is the other question that gets asked. And maybe it's a mixture of those things together, but certainly, yes, part of the story, which is what the government's point, and Leslie was saying about pensions, was definitely there was a higher percentage of that age group that left during and just after COVID.
So lots to think about, and hopefully this webinar has helped answer some questions. I know that we've answered 9 of your own questions today, and hopefully it's been helpful. We want to do more of these. We want to do more of them, ones that you would find useful. So we're going to be emailing you. It's 19:14 now, so we're almost bang on time. So I just want to say thank you to my 4 panelists that we have here. Leslie, as always, brilliant. Holly, all your insights are very valuable. Craig, all of your tax planning advice and financial planning, and Richard for all your economic updates as well. And thank you all for being here and listening. You will all get sent a copy of this, and also we want to hear your feedback as well. So we'll send you a quick survey as to what other things you might like to see in the future webinars that we've got as well coming up. But other than that, thank you very much, and I hope you enjoy the rest of your sunny evening wherever you are, and we'll speak to you hopefully very soon. Thank you very much for being here.